Hi, this is Andy Hoffman of CryptoGoldCentral.com and the World Crypto Network. It's Thursday morning, February 15th, and today's special crypto audio blog is of a potentially very serious topic, which fortunately Bitcoin holders are better positioned to endure than anyone on the planet, which, having followed it as closely as any analyst or commentator over the past 16 years, I felt compelled to discuss after watching even in the context of today's 100% rigged markets, insane movements of the past week. That topic is hyperinflation, or better put, in the interest of not being alarmist or hyperbolic, accelerating monetary inflation. When I say inflation, I am speaking of the purely monetary phenomenon of central banks printing money, which frankly is no different than what 99% of cryptocurrencies do, as the central authorities running them in nearly all cases program unlimited supply and/or limited supply so high it might as well be unlimited. Not to mention many capped cryptos could easily have such caps increased. If, for example, a crypto dictator like Roger Ver decided Bcash's programmed 21 million coin limit was not enough. Of course, no one is forcing you to own cryptocurrencies, as central banks and the governments that authorize or own them do with fiat currencies. When I first invested in precious metals in 2002, actually back then it was just mining stocks, it was under the premise that the dollar was overvalued. Since then, I realized that the problem was not the dollar specifically, but the entire worldwide fiat currency regime. Hundreds of individual fiat regimes have failed in the past, against none that have succeeded, but never before has the entire world been unbacked by fiat by anything simultaneously. In this case, when the U.S. reneged on the Bretton Woods Agreement in 1971 by abandoning the gold standard. The subsequent increase in inflation and debt has been steady, but not alarming, until saturation was finally reached around the turn of the century, causing the first of what has ultimately been a series of ugly and damaging bubbles. Central bank tinkering enabled the dot-com bubble's crash to be mitigated, but the resulting real estate bubble nearly took the system down in 2008. After which, central banks realized that 24/7 money printing, market manipulation, and propaganda were required to maintain solvency. Initially, they hoped to grow out of the problem under the flawed principles of Keynesian economics, but unfortunately, given the Ponzi scheme they were working with, all that accomplished was more debt and inflation, and ultimately the need for more money printing, market manipulation, and propaganda. Fortunately for them, but not 99% of the world's population, that worked for nearly a decade, aided by the maniacal suppression of precious metal prices with paper derivatives, as until Bitcoin arrived, gold and silver were the only monetary inflation barometers the world had ever known. But sure enough, Bitcoin did arrive, not uncoincidentally at the heart of the 2008 financial crisis, when, for all intents and purposes, the fiat Ponzi that commenced in 1971 permanently broke. Fast forward to today, and the level of money printing, market manipulation, and now via QE, zero, and in the case of Europe and Japan, negative interest rates, direct monetization of stocks and bonds, it couldn't be clearer that central banks have literally run out of options, and thus have turned to active, overt purchases of stocks and bonds with freshly printed fiat, in for all intents and purposes, unlimited amounts, to maintain a status quo in which they get richer, the 99% get poorer, and the system becomes increasingly unstable under a veritable mountain of exponentially rising debt. To wit, the Swiss National Bank may now be the world's largest holder of U.S. equities. The Bank of Japan owns more than 80% of all Japanese equity ETFs. The ECB owns more than a third and probably closer to half of all European sovereign bonds. And the Fed, a decade after the financial crisis, as real estate prices have surged to new record highs, still owns more than a third of all U.S. mortgage-backed bonds. In fact, monetization has gotten so out of hand, it's gotten to the point that until last week, it appeared that stock markets in first, second, and third world nations would never be allowed to go down, as valuations have soared to levels exceeding 1929, 1987, 2000, and 2008, despite an extremely weak global economy featuring record debt, overcapacity, unemployment, and inflation. That said, something appears to have incrementally changed in recent weeks, catalyzed first by a plunging dollar and then rising interest rates. The former is an extremely alarming trend, given that the U.S.'s monetary competition is itself so weak, whilst the Fed remains, albeit in increasingly weak fashion, the world's reserve currency issuer. However, like all reserve currency issuers before it, albeit none that operated a global fiat Ponzi, the Fed has so grossly abused the privilege, it turned America in just a few short decades from the world's richest nation to the most indebted by far in global history. This is what is finally spooking the bond vigilantes, and thus thwarting the Fed's efforts to keep rates down, and in turn the dollar, as said vigilantes start to discount higher rates of inflation in the US and lower rates of economic growth than even Europe and Japan, the latter of which has an ace in the hole in the form of widespread Bitcoin acceptance, and likely, in my view, Bank of Japan Bitcoin monetization. Even the US stock market, which hadn't been allowed by the plunge protection team, i.e., the president's working group on capital markets, to fall 10% for the past 2 years, did so as rates surged, the dollar plunged, and economic data dramatically rolled over. And yet, stocks miraculously turned right back around. And by miraculously, I mean that as I write, the dollar is at its low for the move, at levels last seen in late 2014, while interest rates are at the high for the move, at levels last seen in late 2013. In other words, as bad as it gets for the US economy, given that from individuals to corporations, municipalities, and the federal government itself, debt has never been higher and is starting to accelerate its level of growth. Heck, just look at what the US government has done in recent weeks in suspending the debt ceiling, publishing a massive budget busting infrastructure plan, and cutting taxes. To that end, the Treasury Secretary himself just gave a speech at Davos telling the world's financial elite that he favored a weaker dollar. To me, the fact the stock market rebounded so sharply tells me two things, as there is simply no way freely traded markets would act this way. One, the PPT has doubled down on its efforts to stabilize markets, which is nothing new. And two, with a likelihood that I would characterize as uncomfortably high, market participants may be starting to discount the next round of interest rate cuts and/or QE, which, considering that the Fed's balance sheet is already at an all-time high of well above $4 trillion, and rates, despite 2 years of so-called tightening, are still barely above 1%, screams hyperinflation as loudly as possible, let alone when its two main money-printing compatriots, the ECB and Bank of Japan, still have negative interest rates and still are amidst heavy QE programs. In other words, it's not a stretch to believe the markets are starting to worry about accelerating inflation. And then there's the historic inflation hedge known as precious metals, which I started losing faith in last year when I sold all my silver and started CGC, and lost nearly all faith in recently when I sold all my gold. For 15 years, they were the focal point of my investment portfolio, career, and financial mindset. But first, thanks to paper market dilution by the powers that be, and now Bitcoin, I view them as, yes, barbarous relics. Gold far less so than silver, as it will likely retain some modest form of monetary value until the older generations holding it die off, and silver completely, as in my view, the emergence of Bitcoin has, for all intents and purposes, turned silver, which frankly hasn't had much monetary value in years, as evidenced by the record high gold-silver ratio, back into just being a plain old base metal. Hopelessly bullish, but fundamentally ignorant gold holders are getting crazed because the price is back to $13.50. But considering all that's occurred in the monetary world, the fact that it's trading at levels last seen in 2013 should tell you all you need to know about how valuable the market views it. To me, gold has been relegated to an inflation-adjusted savings account with little downside potential and a call option on crisis. Little downside, principally because the mining industry has been decimated by years of price suppression, and yes, the ability to rise strongly if a true hyperinflationary event occurred. That said, just as Bcash eliminated SegWit2x's use case out of existence overnight, I believe Bitcoin has done this to precious metals, which is why I strongly believe, potentially in as little as a decade's time, Bitcoin's market cap will exceed that of gold's, the former being just over 150 billion today, and the latter 7 to 8 trillion. The fact that Bitcoin's price bottomed so rapidly and dramatically is no doubt related to said hyperinflationary fears in some way, shape, or form. That and Bitcoin's typical seasonality, as it nearly always bottoms for the year in early February, and oh yeah, the Wall Street put at $6,000, i.e., the $100 billion market cap that makes Bitcoin investable to nearly all the world's institutions. Throw in the fact that while it's plunging 70%, not a single thing was wrong with Bitcoin. And you can see why multiple factors contributed to Bitcoin's spectacular rebound, which I assure you is just getting started. To that end, it should be noted that Bitcoin's rise in the past week has been significantly more than the stock and gold markets, as well as nearly all other cryptocurrencies, which, while it doesn't prove anything, it potentially portends many bad things for the world and good things for Bitcoin holders. In my view, years of serial market, monetary, and economic data manipulation, alongside increasingly socialist regimes, have jaded the masses of the inflationary pressures that have put them in so much debt, with so little hope for their children's futures relative to the past. This is why Bitcoin was born, and why, in my very strong view, that hope can in time be restored. However, before we get there, the current regime must be destroyed, hopefully relatively painlessly, politically, economically, monetarily, and socially, but likely, at least for some, not. Whether hyperinflation is indeed starting to be discounted by financial markets, we'll likely know soon. Either way, I expect Bitcoin, for a variety of reasons, many having nothing to do with hyperinflation, to be the big winner. However, if fiat currency is indeed on the verge of significant plunge in purchasing power and public confidence, the explosion I anticipate in Bitcoin prices will be historic. Thanks, and have a great crypto day. And by the way, get ready for my one-on-one in 1 hour.